Before we begin, I want to make something absolutely clear. Everything I share in this video is for educational and informational purposes only. I'm not a financial advisor. I'm not a licensed investment professional. Nothing in this video should ever be interpreted as financial advice, investment advice, or a recommendation to buy or sell any asset. Markets move fast. Silver, gold, oil, and commodities in general can swing violently in either direction. You can lose money just as quickly as you can make it. Always do your own research. Speak with a qualified financial professional before making financial decisions, and never invest money you cannot afford to lose. I share my analysis publicly because I believe financial knowledge should not be hidden behind closed doors. Transparency and education matter. And with that said, we need to talk about what just happened today, because today is the moment this entire story has been building toward. If you are new to this channel, my name is John O.G. Over the past 3 days, I have been walking you step by step through one of the most dramatic developments in the commodity markets we have seen in years. On March 8th, I explained that silver was trading around $83 while oil was approaching the $100 per barrel level. At that time, I warned that the Strait of Hormuz was going dark and that before the Monday market opened, something significant could unfold. And then on March 9th, I came back with another update. Oil had exploded higher and crossed $110 per barrel. Iraq's oil production had collapsed by nearly 70%, and Asian markets were falling sharply. Yet silver remained strangely calm at $83. Then, on March 10th, the market delivered one of the most violent moves I have ever tracked. Oil spiked to $119 per barrel, and then collapsed all the way down to $87 in a single session. And during that same period, something extremely important happened quietly in the background. JP Morgan moved 169 million ounces of silver out of deliverable vaults and into non-deliverable status. And through all of that chaos, silver barely moved. It stayed near $83. Now, today is March 11th, and if you have been watching this channel over the past few days, you already knew something the majority of the market did not understand. Because today, silver finally moved. Silver touched $90 per ounce, while oil dropped on peace headlines. And this is exactly the signal I was waiting for. Now, when I say this is the moment I was waiting for, I do not mean I predicted a specific number on a specific date. That is not how markets work. What I was watching for was the moment silver would stop reacting to oil and geopolitical headlines and begin trading based on its own underlying fundamentals. In other words, I was waiting for the decoupling. And today, we saw the first unmistakable sign of it. Oil fell today because of peace signals. Political statements suggested that the conflict affecting Middle Eastern oil production was nearing completion. When geopolitical tension fades, oil prices typically fall. That is completely normal behavior for an energy market that is heavily tied to global political risk. But silver did not follow oil lower. Instead, silver moved higher. It climbed to $90 per ounce and held strength while oil declined. That is not a geopolitical trade. That is a fundamental trade. That is the market starting to price silver based on supply and demand rather than fear headlines. Think about everything we discussed over the past few videos. JP Morgan moved 169 million ounces of silver out of deliverable vaults. The total registered silver inventory on COMEX is roughly 86 million ounces. Yet open interest in silver futures currently represents more than 4 contracts for every ounce that could actually be delivered. In simple terms, that means the paper market has promised far more silver than physically exists in deliverable form. And when JP Morgan moved that silver out of deliverable status, the amount available for delivery shrank even further. If even a portion of contract holders demand physical delivery, the exchange would face a serious supply problem. That structural issue does not disappear just because political headlines change. The Strait of Hormuz situation may calm down, oil production may recover, but the physical silver removed from deliverable vaults is still gone. The supply imbalance is still there, and that imbalance is what the market is beginning to recognize. Today's move toward $90 is not simply a price spike. It is the market starting to reprice silver based on the reality of tight physical supply. Now let's look at the broader context. Gold is currently trading near $5,200 per ounce. Silver recently touched $90. That places the gold to silver ratio around 58 to 1. Historically, that ratio has been much tighter during commodity bull cycles. In the early 1980s, the ratio dropped close to 15 to 1. In 2011, it compressed to around 32 to 1. If the ratio simply moved to 45 to 1, while gold stayed near current levels, silver would be trading above $110. And that would still be far from the historical extremes. This is why many analysts believe silver remains significantly undervalued relative to gold. But there is another layer to this story that most people do not fully understand. The silver market actually operates in 2 separate layers. The first layer is the paper market. This includes futures contracts, derivatives, ETFs, and large institutional trading positions. The second layer is the physical market. This involves actual silver bars, coins, industrial usage, and sovereign purchasing. For years, the paper market has largely dictated the price. Large institutions with enormous short positions have been able to influence price movement through futures markets. Meanwhile, physical demand has often been stronger than the paper price suggests. Just days ago, physical silver in Shanghai was trading with a premium of more than $12 above the New York COMEX price. That means buyers in Asia were willing to pay significantly more just to obtain real metal. That type of premium sends a powerful message. It tells you that the physical market believes silver is undervalued. Today's price movement toward $90 could represent the beginning of the gap between paper and physical markets starting to close. And when that gap begins to close, price adjustments can happen very quickly. Now let's talk briefly about the institutional side of this market. Major financial institutions have already acknowledged silver's potential. Bank of America has previously discussed a long-term price scenario where silver could reach $300 per ounce. That is not a random number. Those projections are based on supply data, industrial demand growth, and long-term commodity cycles. Meanwhile, JP Morgan purchased millions of ounces of silver earlier this year at prices near the high 70s. And shortly afterward, they reduced the amount of deliverable silver on the exchange. That sequence of actions suggests strategic positioning by one of the largest players in the metals market. When institutions position themselves early, retail investors, who understand the bigger picture, sometimes benefit later in the cycle. Looking ahead, there are several indicators worth watching over the coming days. First is COMEX open interest. If open interest remains extremely high relative to physical inventory, delivery pressure continues to build. Second is the gold to silver ratio. Continued compression would signal that silver is outperforming gold in the current cycle. Third is the US dollar index. Since metals are priced in dollars, a weaker dollar often supports higher commodity prices. Fourth is any sign of large delivery requests from institutional traders. If physical demand suddenly accelerates, the market reaction could be very sharp. For long-term silver investors who have been holding through years of sideways movement, I understand the frustration. Silver has spent long periods underperforming while other assets surged, but the structural conditions forming today are very different from what we saw in previous years. Industrial demand continues to rise, especially from solar technology, electronics manufacturing, and electric vehicles. Mining supply has remained relatively flat. At the same time, investment demand is growing again as institutions return to the metals market. When demand rises while supply remains constrained, prices eventually adjust. That is basic economics. If the gold to silver ratio moved to 40 to 1 with gold near $5,200, silver would be roughly $130 per ounce. If the ratio moved toward 30 to 1, silver could approach $170. Those numbers are not predictions with dates attached. They are simply mathematical scenarios based on historical relationships between gold and silver prices. The timing of any repricing remains uncertain. Markets rarely move in straight lines. Volatility will continue, and large swings in both directions are always possible. But today's price behavior, silver rising while oil falls on peace news, suggests that the market may finally be shifting its focus toward the underlying fundamentals. And that shift is exactly what I have been watching for throughout this entire 3-day sequence. If you already hold physical silver, short-term fluctuations should not distract from the bigger structural picture. If you are considering entering the market, it is important to understand your own risk tolerance and investment horizon. Silver can move extremely quickly, and volatility is part of the asset class. Leverage, margin trading, and option strategies carry additional risks and should be approached with caution. Staying informed is the most valuable thing any investor can do. That is the purpose of this channel. For the past 3 days, we have tracked this situation in real time. March 8th, we saw the warning signs. March 9th, the disruption intensified. March 10th, we uncovered the vault movement.